Hi guys, so this is our first foray into online classes. What I'm going to do for this class is simply review what we covered in the last class, and there may be one or two new things that we go over. If you should have any suggestions on how to make these classes more interesting or more informative or whatever, please don't hesitate to let me know. Now, as usual, I'll be giving you an assignment at the end of class. I expect you to read that assignment, to do your best to answer the questions and problems, and then, as usual, we'll go over that in the next class. What will not be usual, unfortunately, is that you'll not be able to ask questions in real time. But you can always email or call me. I've got voicemail. Both in the office and at home, so I will be sure to get back to you. Email's probably better, so that if it's something I think the whole class would benefit from, then it'd be easier for me to send it to the class. As I get more proficient on Zoom, we may be able to have a Q&A session by Zoom. I'll have to we'll just see how that goes, and I'll get back to you about that later if I should get more proficient on Zoom. Also, one other thing that I want to mention to you, as you can see, we're beginning with class 20. There are 14 weeks in a term, so technically there would be 28 classes. We may have less than that because since we're not going to be able to ask questions in real time, that's going to save some time in going through these classes. So we may have a bit less than 28. We'll just have to see. I am going to be posting your class on the day of the class. So each week I will be posting a couple of classes. So we'll, if you have any problems or anything, again, don't hesitate to contact me. So looking at the material that we were talking about last class, which is education benefits. Now, we had talked about some of the benefits, tax benefits that we had discussed prior to our delving into education benefits more deeply. So these were Section 117, the exclusion for scholarships and fellowships; 127, the exclusion of up to $5,250 for employer-provided educational assistance; Section 108F, the exclusion for the discharge of certain student loan indebtedness. This is where the student promises to work in certain underserved professions in certain geographical areas for defined periods of time. That now includes, 108F now includes death, discharge by reason of death, or total and permanent disability, at least until 2026. We finally had discussed under 132, this dealt with employer-provided fringe benefits. 132A3 provided an exclusion for employer-provided working condition fringe benefits. This was tied to the Section 162 business deduction, which we'll cover later. Now, I'll also mention to you that you might want to take a look at IRS Publication 970, entitled Tax Benefits for Education. It goes over most of the stuff that we'll be covering. Now, our first benefit that we had talked about is the American Opportunity Tax Credit, the AOTC, under Section 25A. Now, remember, a tax credit offsets your actual tax liability dollar for dollar. Now, Section 25A actually provides two tax credits. In addition to the AOTC, there's also the Lifetime Learning Credit, the LLC. Now, under the AOTC, the old HOPE credit was beefed up and then renamed the American Opportunity Tax Credit. The old HOPE credit provided a credit of $1,500 per student. That's now been increased to a maximum of $2,500 per student. This is applied against the first $4,000 of eligible education expenses. Now, the way this new amount works is that 100% of your qualified tuition and related expenses, that is, tuition, fees, textbooks, and course materials, is allowed up to $2,000. The next $2,000 of your eligible expenses are allowed up to 25% of those. So that's the amount over the first $2,000 up to $4,000. So the first $2,000 gives you $2,000 of credit. Second $2,000 of qualified expenses gives you $500 of credit for your total of $2,500. Note that this credit is not indexed for inflation, so it does not increase each year. The AOTC can be claimed up to 4 years of post-secondary education per eligible student. This is under Section 25A I-2. It is now partially refundable, so up to 40% of the credit is refundable, that is up to $1,000. Now there are phase-outs, which means that higher income taxpayers are not going to get the benefit or the complete benefit of the credit. The phase-out limits for the AOTC are $80,000 to $90,000 for single taxpayers and $160,000 to $180,000 for married taxpayers filing jointly. Now, this is a per student credit, so taxpayers with 2 students in college, for example, at the same time, may take a $5,000 credit. Under both the Old Hope credit and under the AOTC, in order to be eligible for the credit, the student must have no felony drug conviction on his or her record. These include both state and federal convictions. Now, as I mentioned to you in class, this is an odd requirement because first, it's arbitrary. There's no similar ban for rapes, murders, and theft. Second, it's a blunt instrument. It fails to take into account the nature of the substance, how much did the person possess, and was this the person's first offense or not? Criminal drug laws vary widely from state to state in, first of all, whether the substance is illegal. So, for example, marijuana is legal for recreational use among adults in 11 states, illegal in others. Second, it may vary from state to state about how much of a substance is required for a felony. It also may depend upon the vagaries of prosecutors and plea bargains on the one hand, and adequate representation on the other. And finally, another reason that this is arbitrary is it does not apply to the LLC. It applies only to the AOTC. Now, the second credit under the AOTC, as I mentioned, under 25A, as I mentioned before, is the Lifetime Learning Credit, which is available to you now. This credit applies to any year of post-secondary education. So in this sense, it's less restrictive than the AOTC. It is a non-refundable per taxpayer credit of up to 20% of the first $10,000 of qualified educational expenses. So that means that the credit is $2,000 maximum. The qualified expenses have to have been paid during that taxable year on behalf of the taxpayer's spouse, and dependents. Because the LLC is a per taxpayer credit, it does not vary according to the number of students in the taxpayer's family. So for instance, no matter how many students you may have in college at one time, you can only take one $2,000 credit on your return. The student can be enrolled in an undergraduate or a graduate degree program, or take courses at an eligible institution to acquire or improve job skills, even if that student is enrolled on less than a half-time basis. You do not have to be a candidate for a degree, and you may claim this credit even if you've been convicted of a state or federal felony drug offense, as I mentioned before. The phase-out limit here is $40,000 to $50,000 for single taxpayers and $80,000 to $100,000 for married taxpayers filing jointly. So this credit is phased out at lower levels than the AOTC. If you can elect the AOTC, it makes no sense to elect the LLC unless you do not have much income to offset, or you're in graduate school or beyond your fourth post-secondary year of school. Who can claim the credit? Well, under the Tax Cut and Jobs Act of 2017, personal and dependency exemptions are repealed through 2025. So the person who's responsible for the loan gets the benefit. The general rule with all of the educational benefits is no double dipping unless specifically authorized. So any expenses that you use to claim the LLC cannot be reused to claim another tax benefit. By the same token, only one credit is allowed per student, so you cannot claim both credits for the same student in the same taxable year. Note that there's no limit, though, on the number of years that the LLC can be claimed. Under current law, qualified scholarship amounts, and this includes Pell Grants as well, received by a degree candidate at a qualifying educational organization are generally excluded from gross income under Section 117. Now, we had talked about this earlier. Pell Grants are need-based scholarships awarded by the U.S. Department of Education. The amount of Pell Grant varies according to whether the student is full-time or half-time and according to the expected family contribution. But it is not a loan, so it does not have to be repaid. Basically, these are used to defray the costs of undergraduate education, but on certain occasions, they may be used for postgraduate education. Scholarship amounts are not only excluded from gross income, or they're only excluded, if they're used for qualified tuition and related expenses. As we had seen before under 117, this category does not include room and board. For students with scholarships, and that includes Pell Grants, the process for claiming education-related tax credits like the AOTC is unusually complex and can result in many eligible students and parents, if the student is a dependent, foregoing the tax credits for which they otherwise qualify. This is a really big problem because there are about 7 million students. This is about a third of all students receive Pell Grants, and many more than that have regular scholarships. So this results in hundreds of millions of dollars of unclaimed credits each year. Here's the problem. Under current law, a student may choose whether to allocate her Pell Grant and any other scholarship to tuition, fees, and course-related materials, or to living expenses when she is filing her tax return. This choice is important because if the student allocates her Pell Grant or other scholarship to tuition and fees, the scholarship reduces the amount of expenses eligible to be used to claim the education-related tax credits. If the scholarship is allocated to living expenses, though, then the scholarship becomes taxable for the student. Now, students have this choice of how to allocate that scholarship, regardless of how the school applies the scholarship. Maximizing the total value of the scholarships and tax benefits can therefore require complicated calculations of the value of the credit relative to the tax liability resulting from counting the scholarship as income. Students may not understand that they have this option, and many would benefit from better guidance in their decision making. The next benefit for education is found under Section 221, and this is a deduction for student loan interest. Note that this is a deduction, not a credit. It's a very favorable deduction, though, because it's an above-the-line deduction authorized under Section 62A17. It allows a deduction of up to $2,500 a year for interest paid on a qualified educational loan. Under current law, an individual may claim this deduction for interest on any qualified educational loan for qualified higher education expenses of the taxpayer's spouse, or dependents. The maximum yearly amount of this deduction is $2,500, so it's the lesser of the amount of the actual interest that you paid that year, or $2,500. Only taxpayers with modified adjusted gross income below certain inflation-adjusted amounts qualify for this deduction. For taxable years 2019 and 2020, the phase-out range is $70,000 to $85,000 for single taxpayers and $140,000 to $170,000 for joint filers. Since this deduction is above the line, it applies regardless of whether the individual itemizes or not, which is really good because since the 2017 Tax Act, it becomes more difficult to itemize deductions. The interest payments are deductible for as long as it takes to pay off the loan. And regardless of whether you make a voluntary payment of interest before the start of the repayment period or you make a payment during a deferral period. So in other words, the interest is deductible regardless of when you pay it. You cannot take this deduction if your filing status is married filing separately. So if you're married, you must file a joint return in order to be able to take this deduction. Now, a trap here is that only the person who's legally obligated to make the interest payments may deduct that interest. This is under the regs at 1.221-1B1. So if your parents took out the loan to pay your qualified education expenses, they are entitled to the interest deduction under Section 221. Now there is a marriage penalty here. The overall maximum on a joint return is $2,500, even if both spouses are repaying loans. That's under Section 221E. Qualified expenses here include tuition, fees, room and board, books, supplies, equipment, and other necessary expenses such as transportation. The indebtedness must be incurred exclusively to pay for higher education expenses, and the student must be enrolled on at least a half-time basis. If you take the deduction for student loan interest, you cannot also take the AOTC or the LLC for those same expenses. So again, no double dipping. But you can take the AOTC or the LLC and then reduce your qualified educational expenses by those amounts and then take the 221 deduction. Effectively, student loan interest is not fully deductible until after graduation. Also, amounts used for higher education and excluded by virtue of being employer-provided educational assistance under 127, Series E, and I savings bonds under 135, qualified tuition programs under 529, and educational savings accounts under 530, or qualified scholarships and fellowships excluded under 117. All of those will reduce the amount of qualified educational expenses. So again, no double dipping. Now the example here is, if you take the LLC, then reducing your eligible expenses means reducing them by $10,000. That was considered for the credit, not reducing them by the $2,000 credit. If you have a Roth IRA or a regular IRA account, you may take an early distribution from either of those accounts without the normal 10% penalty on early withdrawals. if you use the money to pay qualified higher education expenses of yourself, your spouse, your child, or your grandchild. Qualified expenses here include tuition, fees, books, supplies, and equipment at a post-secondary educational institution. Graduate level expenses also will qualify. Now, up to this point, we've been discussing benefits that are currently available to you or to your parents. The following benefits that we're going to be talking about, and there are 3 of them, are planning devices. These can be used by parents or grandparents of small children to prepare for those children's education. So the first one we're going to talk about here is qualified savings bonds. These are Series EE and Series I bonds. The tax benefits for these bonds are covered under Section 135. These bonds offer several tax benefits in funding higher education. If they are redeemed to pay the costs of higher education, the interest that would normally be includable is excluded to the extent that the proceeds are used to pay tuition and fees for the taxpayer, taxpayer spouse, and dependents. This is under Section 135C2A. As we mentioned in class, the bonds must be purchased by a taxpayer who's at least 24 years old and who is the sole owner of the bond or a joint owner with a spouse. There's no exclusion if the bonds are purchased by a parent and placed in the name of a dependent, or they are purchased by a child under the age of 24. The phase-out limitation for 2020 is $82,350 to $97,350 for single taxpayers and $123,550 to $153,550 for married taxpayers filing jointly. If the taxpayer is married and files separately, no exclusion is allowable. The Series EE and I bonds also offer favorable tax treatment for graduate level education. Any amount of bonds can be purchased up to the cost of the education, so no limit on the amount that can be purchased. The 25A credits may be claimed along with the 135 exclusion, but again, the amount of the credit reduces the qualified expenses by the amounts considered under those provisions. So too do scholarships, fellowships, employer-funded educational assistance, and other tuition reductions. So the next benefit, this is planning benefit that we'll talk about, are qualified tuition programs covered under Section 529. These programs have been around for years, and although they're state offerings, not federal, you can defer federal taxes on a fair amount of money, that is up to $100,000 in some cases. And here's how it works. The state creates a fund that qualifies under Section 529, and you can make cash contributions for the benefit of a designated beneficiary to cover the cost of that beneficiary's higher education. It works like a tax-free savings account. So the contributions are made after tax, but they accumulate tax-free. There's no income phase out here, but then the contributions are not deductible either. These contributions are considered a gift to the beneficiary, but they are not included within Section 2503E. Now, 2503E is a special provision found under the estate and gift tax laws. This allows an unlimited gift tax exclusion for amounts used to pay higher education expenses. So that means then that without any of these other benefits, if you are paying for your child's college education, that is not considered a gift subject to gift taxes. But if you are contributing to a 529 QTP, that is subject to gift tax. However, there is a special rule that allows the contributor to contribute from 2018 onward up to $75,000 in 1 year, and then to spread that payment out over 5 years for purposes of gift tax. The reason for this is that currently the annual per donee exclusion, that is the amount that you can give to a donee without having to pay gift taxes, is $15,000 per donee. So for 5 years, you would have contributed $75,000. So once you contribute up to $75,000 in 1 year, you may not make a contribution again for the next 4 years under this special exclusion. In the alternative, the state can create a fund in which various eligible schools participate. And then you can either purchase tuition credits from the college of your choice, or you can make cash contributions to an account for a designated beneficiary that are earmarked to cover that person's costs of higher education. There are no phase outs here, so anyone can contribute regardless of income level. And by the way, Georgia also has a qualified tuition program. When the student begins college, that is post-secondary education, the student can take a tax-free distribution from the account to cover qualified education expenses. And these include tuition and fees, room and board, books, supplies, and equipment. So this is a very liberal definition of qualified expenses. It also covers the cost of a computer and peripheral equipment. It also covers up to $10,000 that may be used for expenses of public, private, or religious elementary or secondary schools. Also, after 2018, up to $10,000 may be excluded if it's used to pay student loans. This is essentially, a QTP is essentially a trust for the child. Any excess distribution, that is an amount not spent on a qualified expense, is taxed to the child. Now this is the earnings only, at the child's rate, which is usually a lower rate than the parent's rate. This is taxed under Section 72, under the same principles we talked about earlier. So part of the distribution will be taxable and part will be tax exempt. Any amount that's taxed, or any amount that's not used for qualified expenses, will be subject to a 10% penalty. However, if you have any unused amounts, these may be rolled over within 60 days to an eligible family member or to other plans. The downside is that once you make the contribution, you have no control over the investment. You might do better on your own, although you do have the benefit of the tax deferral. Because a tax deferral works best over time, the longer the time you have to save, the more attractive it becomes. You can also claim the HOPE and claim the AOTC and the LLCs while you're receiving the distribution from a QTP. Amounts claimed under the AOTC or LLC will reduce qualified expenses, again, no double dipping, as will amounts under 117. Now, some questions that you may have here. Does this guarantee my child a place in that college if I buy credits for a specific school? And the answer is, afraid not. What if the beneficiary decides not to go to college? Well, in that case, you can roll it over to another beneficiary or to another state plan. Otherwise, it's taxable to the beneficiary and subject to the 10% penalty. What if the beneficiary dies? In that case, it will be taxable, but there's no 10% penalty that applies. What if the beneficiary gets a scholarship that covers most of the expenses? So if the student receives a scholarship or fellowship that's excluded under 117, the qualified expenses paid with that amount are reduced, so they may not be considered for purposes of the QTP benefit. If the scholarship does not cover all qualified expenses, and you get a distribution from the fund, to the extent it's used to pay qualified expenses, it's tax-free. If it's not used to pay qualified expenses, it is taxed under Section 72 at the student's rate, but again, no 10% penalty applies. Otherwise, if you have a lot left in the fund, it can be rolled over to benefit another family member. Now, I'll just mention to you a newer type of QTP plan. It's been in effect since late 2015. This is a special QTP. It's covered under Section 520A, and it's called an ABLE plan. And that's an acronym for Achieving a Better Life Experience. And this applies to disabled students. It works basically the same way as the regular QTP, but with the ABLE plan, there's a broader definition of qualified expenses, which includes special education services and tutoring, healthcare costs, assistive technology, and housing. It can also cover legal fees, funeral, and burial expenses. The next benefit, which is our last benefit we're going to talk about here, is the 530 Coverdell Educational Savings Account. Now, essentially, this is an IRA that allows parents to shelter earnings on college savings. The Educational Savings Account, or Coverdell ESA, is named for the late Senator Paul Coverdell from Georgia. The ESA has to be created exclusively for the purpose of saving tax-free dollars that will eventually be used toward a child's elementary, secondary, or higher education expenses. So these can be used from kindergarten through college. You can contribute up to $2,000 per child annually, and the contribution has to be in cash. You can make those contributions until the child reaches age 18, unless the child is a special needs beneficiary. Because of the age limit, this account obviously is not going to be useful for older children. Also, because of the relatively small amount of contributions that can be made to a Coverdell account, you should be sensitive to the maintenance fee of the financial institution that holds the account. Even a small annual fee could significantly affect the investment return on the account. Like the Roth account, this contribution is non-deductible. The $2,000 ceiling is phased out for higher income taxpayers with income between $95,000 to $110,000 for single taxpayers, and between $190,000 and $220,000 for married taxpayers filing jointly. If your modified adjusted gross income exceeds those threshold limits, you can make a gift of $2,000 to another family member, such as a grandparent, who can then make the contribution. No contribution can be made in any year that the beneficiary is receiving distributions from a QTP. Although contributions may be made to both a Coverdell and a QTP in the same year for the same beneficiary. While the contributions are not tax deductible, the earnings accumulate tax-free, and so are the withdrawals if the money is used for undergraduate or graduate level room, board, or tuition. If the beneficiary does not attend college, or a remainder of the savings or the earnings are left, the money must be withdrawn subject to tax in accordance with the principles of Section 72. This includes a 10% penalty. It must be withdrawn within 60 days after the child turns age 30. Before then, the account balance can be rolled over or transferred tax-free to another Coverdell account for another family member under age 30. It used to be that in the year that a distribution, which was excluded from income, was taken from the Coverdell to pay education expenses, no AOTC, LLC, or business-related educational deduction was allowed. That has now changed, so that tapping the Coverdell account no longer bars using the AOTC or LLC for other costs. You can make a deposit by April 15th that can count for the prior year, and then you can also make another contribution for the current year. So in other words, it's possible to make two contributions in a single year if you did not make a contribution in the prior year. If the beneficiary receives distributions from both a Coverdell and a QTP, and the distribution goes to pay for qualified expenses, then all the distributions are tax-free. Otherwise, allocations must be made between the Coverdell and the QTP in a reasonable manner. Now we're going to turn to problem 2 on page 229. In this problem, we have a young professional couple who are concerned as to the funding of their child's higher educations. Their school has a qualified tuition program, and they've also heard about savings bonds and Coverdell accounts. What is your advice to them? Well, first, the young couple's primary concern is going to be having enough money to pay for their children's higher education. So they're going to be interested in the vehicle that's going to allow them the greatest accumulation, usually with the most control. The tax considerations probably are going to be secondary to them at this point. In addition to the benefits that we discussed, there is, of course, a regular old savings account for the child. So you can contribute any amount to this. There's no phase out, but it's considered a gift. So anything over $15,000, $30,000 for a joint contribution per donee per year is subject to the gift tax. If it's established in the name of the child, that is, under the State Uniform Gift to Minors Act, the child has access to it when the child reaches the age of majority. So there's no control, you have no control over the account after the child reaches majority. Also, as a regular savings account, it is not tax exempt. So the earnings will be taxable each year as well. Now, we discussed benefits available to current students or their parents. These benefits that we discussed later, savings bonds, QTPs, Coverdells, as I mentioned before, these are planning devices that can be used by parents or grandparents of small children to prepare for their education. Now, in determining whether to purchase a savings bond or contribute to a QTP or invest in a Coverdell, there are a wide variety of factors that your client may want to consider, such as the type of higher education costs that qualify for an exclusion. Second, the potential amount of the exclusion. Third, the phase out of the exclusion for both contributions and distributions. Fourth, the interrelationship with other benefits, such as the Section 25A tuition credits. And finally, the possibility of rolling over any excess amounts into a program benefiting other family members. First, let's look at the type of costs that are covered. For qualified savings bonds, these are Series E, E, and I bonds covered under Section 135. Qualified education expenses for this purpose are tuition and fees for the taxpayer, spouse, and dependents. This is the most restrictive definition of any of those three benefits. No room and board and no expenses involving sports, games, or hobbies are allowed, but it can be applied to expenses at the graduate level. Now, here's an example of how this benefit works. So let's say that you buy a savings bond for $6,000 and you hold on to it for a number of years until your child is ready to begin college. When the child gets ready to start college, you redeem that bond, and now it's worth $10,000. So the difference between the $10,000 that is redeemed and the $6,000 that you paid is $4,000, and that $4,000 constitutes interest. So let's say that your child's qualified college expenses total $18,000, and you or the child are eligible for the AOTC or the LLC. We have your $18,000 in qualified education expenses, and let's say that you decide to take the LLC. Let's say that your child is entering law school and not college. So in order to take that $2,000 of LLC credit, $10,000 of qualified expense is considered. So it's 20% against that $10,000 that will equal your $2,000 of credit. So therefore, we've already used that for the LLC. So we're going to have to offset our qualified education expense by that $10,000. That gives us $8,000 of qualified education expense that's left. Now, looking back at our bond, we're going to use our bond to pay that amount. So we've got $8,000 of qualified education expenses. We're using our entire bond to pay costs. And so 80% of our bond has been used for qualified educational expense. We've got $4,000 of interest that would otherwise have been taxable. But we've now used 80% of our bond to pay qualified educational expenses. So 80% of that $4,000 of interest will be excludable. And that turns out to be $3,200. So $3,200 will be excludable, $800 will be includable as interest. Now let's say that your child is starting college, and so now you're going to use the AOTC. Again, we have our $18,000 in qualified educational expense. We're taking the AOTC of $2,500 of credit, and we have considered $4,000 of qualified educational expense in order to take that $2,500 of credit. So that leaves us with $14,000 in qualified educational expense. We're now using $10,000 of our bond to pay part of the $14,000 of qualified expense. And so since our qualified expense exceeds the amount of the bond, all of our interest is going to be excluded. So that's the way this works. Now, let's look at the other types of benefits here and what sort of costs they cover. So QTPs, qualified educational expenses here include tuition and fees, room and board, books, supplies, and equipment under Section 529E3. This is a very liberal definition of expenses, much more liberal than the definition under Section 135. It also covers the cost of a computer, internet access, software, and peripheral equipment that's primarily educational in nature. It does not cover sports, games, or hobbies, though. The 530 Coverdell educational savings accounts can be used toward a child's elementary, secondary, or higher education expenses. So as I mentioned, they can be used from kindergarten through college. The Coverdell account has the most liberal definition of qualified expenses. Remember, under the Tax Cut and Jobs Act of 2017, up to $10,000 may be used for expenses of public, private, or religious elementary or secondary school. Because it has the most liberal definition of qualified expenses, in addition to that, the exclusion is allowed not only for tuition and fees, but also for books, supplies, equipment, special education needs, and generally room and board, as well as for expenses of elementary and secondary education. This is found under Section 530B2. With respect to all three types of benefits, the amount of the exclusions are first reduced by any amounts excluded under any other tax benefit provisions, such as 117, 127, 25A, etc. Now, an exception to this, though, is 102. So gifts are not included within the double dipping exception. Generally, the name of the game here is no double dipping with any of these benefits except for 102. So you can pay for your child's college education and still be able to use the AOTC or the LLC. The child can. Now, the potential amount of the exclusion. Under Section 135, the savings bonds, you can purchase any amount of these bonds, and the full amount of the interest on the bond is potentially excludable. To the extent it's taxable, the interest is taxed to the bondholder, who must be at least 24 years old. This is the person who will be receiving the payments under the bond. This usually is not going to be the student, so it will be taxed to the parent, grandparent, etc., at that person's tax rate, if it's taxed at all. You don't need to worry about gift taxes here because this is not considered a gift. The 529 QTPs, you can contribute any amount, there's no restriction, except that the contributions must be reasonably related to what the beneficiary will need for higher education. These contributions must be contributed on behalf of a specific beneficiary, so they are considered gifts to that beneficiary. Therefore, the person making the contribution needs to be concerned about gift taxes. So anything over $15,000, $30,000 for joint filers, will be subject to gift tax, with the exception that the $75,000 can be contributed in 1 year, that's from 2018 on, and spread out over 5 years to avoid the gift taxes. Otherwise, the earnings are excluded when earned, and the distributions are excluded to the extent that they're used to pay qualified higher education expenses. Any excess distributions are taxed using Section 72 principles. This is found under Section 529C3. The excess will be taxed to the beneficiary, and any income that's taxed is also subject to the 10% penalty. The donor does not have any control or guaranteed return on this money. It is subject to market fluctuations. The Coverdell accounts under Section 530, they're basically the same as the QTPs, but the contribution is more limited. So you can only contribute up to $2,000 per year per beneficiary up to age 18. Excess distributions taxed the same as under Section 529, but instead of a 10% penalty, they're subject to a 6% excise tax. This is under Section 530D. Phase outs. So under 135, the savings bonds, the interest exclusion on these bonds is phased out in the year for taxable year 2019, is phased out in the year of the distribution if the bondholder's modified adjusted gross income is between $81,100 and $91,060 for single taxpayers, $121,600 and $151,600 for married taxpayers filing jointly. For taxable year 2020, the range is $82,350 to $97,350 for single filers and $123,550 to $153,550 for married taxpayers filing jointly. No exclusion if you're a married taxpayer filing singly. This is under Section 135B as in boy 2A. This amount is adjusted for inflation. It makes it hard to plan if a young couple purchases the bonds for their child or children. By the time the distribution is made, if the couple's modified adjusted gross income is over the phase-out limit, then their tax benefit is either eliminated or reduced. So therefore, it's much better for a grandparent or someone on a fixed income who is more likely to be retired by that time to purchase these bonds. Under 529 for QTPs, a major advantage to using a QTP is that there's no phase out, either on the contribution or on the distributions. For the 530 Coverdell accounts, the contribution that may be made to a Coverdell account is $2,000 per year, but it's phased out when the contributor's modified adjusted gross income is between $95,000 and $110,000 for single taxpayers and $190,000 to $220,000 for married taxpayers filing jointly. Note that this phase-out amount, though, is higher than the 135 phase-out amount. Another thing to consider, the interrelationship with other tax benefits. So your 135 savings bond. When you get a distribution, you can claim other benefits at the same time, but you must reduce your qualified expenses for 135 purposes by any amount that overlaps with sections 25A, 529, 530, 117, 127, etc., but not 102. If you use the bond to pay for non-qualified expenses, you're going to be taxed on the interest, but there's no 10% penalty or 6% excise tax penalty. The QTPs are basically the same, except that you do have a 10% penalty if you use them to pay for non-qualified expenses. 530, basically the same too. You have to reduce all your other benefits. In addition, though, no contribution may be made to a 530 Coverdell account for a beneficiary if a contribution is made in that year by anyone for that beneficiary's benefit to a 529 QTP. Rollovers. Although it's not covered in detail in the text, there is a possibility of rolling over both a QTP and a Coverdell to other members of a beneficiary's family. Essentially, savings bonds have the same feature because the bond interest is not restricted to a particular beneficiary when the bond is purchased. It is only restricted to use by the taxpayer, taxpayer's spouse, and dependents. This is under Section 135C2. So in effect, the bonds may be rolled over between members of the family, that is, used for various family members. Although family is not defined as broadly under 135C2 as it is under 529 at 529E2 and 530 at 530D4. This ends the material for this particular class. I think I'd already given you the assignment for the next class, which is to read chapter 12 and look at the problems within that chapter. So see you in the next class.